The Fed minutes are upon us, and we have Peter Hugg on this edition of For Pete's Sake to help us sort it all out. Peter, thanks for joining me.
You're welcome, Alec.
So, Pete, gold prices were hit hard yesterday. Very strong U.S. dollar. Following news from the ECB early in the morning, housing data was also very strong. So, I mean, was this just a one-off for the U.S. dollar, kind of regaining its earlier swagger?
Well, you know, I think the U.S. dollar's strength or weakness is, as with the metals, is going to be data-driven. Yesterday, we had two events. One, the ECB announced that they would front-load their bond purchases more aggressively for May and June. Because typically in the summer in Europe, most people are, for the most part, they just close their businesses in August. So they don't see the liquidity being there in the summer. So they're front-loading their bond purchases now with the anticipation that they'll buy less in July and August. But the overall package, if you read through the initial headline, is that they haven't changed their process. They're still looking at a target of $65 billion a month. So that was a knee-jerk reaction, which created some selling in the euro, and obviously had an impact on the gold market, which has been very, very dollar sensitive in the short term. Added to that was the housing starts, which came out yesterday, which were also better than expected. So again, the talk that the Fed now may have some ammunition to move earlier than expected. Again, I'm not in that camp, but that came into the market at the same time the ECB indicated that they were going to do a more aggressive funding, short-term funding, liquidity funding in anticipation of a slower summer demand. Hit the dollar on the upside and took the momentum out of the gold market, and the easiest path was down as traders took their profits on the recent rally.
So, Peter, Fed obviously coming out later this afternoon. Now, we saw, like you mentioned, the strong housing data that came out yesterday. We also saw the disappointing data that came out last week, so it seems like a week-to-week thing here. Having said all that, when you look at what Janet Yellen is going to be putting out, do you expect it to be more dovish, hawkish? What are you expecting from her?
Yeah, I don't see anything in recent data. You can look at the housing data yesterday, but prior to that, the prior week's data was actually relatively weak. So I don't see Yellen changing her stance or her format. I think the Fed will say this is a data-dependent decision, and the data right now continues to be mixed. And as long as the data remains mixed, I think the Fed stays on hold and doesn't pull the trigger early. So that's what I expect to come out of the minutes. We have some Fed governors right now indicating verbally that they're looking at a 2016 event as opposed to something that may occur in September or December of this year. So, I think the jury's mixed on that, and until the Fed has a very, very strong sense that the U.S. economy is now on a growth path, that they're probably going to stand pat. So I would expect that concept would be considered more dovish than bullish for the metals markets.
Now, Peter, there's been some talk out there with analysts putting out notes this week that U.S. recession is possibly in the cards, might be premature. What do you make of that?
Well, it's always a possibility. The first quarter was growth, which was, in my opinion, will probably come in negative. Was argued to be, to some extent or large extent, weather related. So now we're in the second quarter, so you can't use the weather argument. And, growth is still tepid. I don't expect second quarter growth to be much above, if this high, 1.5%. So we're not anywhere near a recession yet in the U.S., but that doesn't mean that the economic recovery in the U.S. is sustainable. The jury is still out on that. And should the U.S. slip back into recession or get closer to recession, there are some serious issues, because now the Fed has absolutely no bullets left in the gun to fight that recession, except to renew bond purchases, which would be a major event should that occur. Anybody calling for that event now, I think, is premature. There's certainly no evidence that the U.S. is slipping into recession yet, but it is, a potential warning signal that it needs to be looked at, and it again will be data dependent. And if the data continues to weaken, is it possible that the U.S. slips into a recession by third quarter? It is possible, not likely, but possible. And what does the Fed do in that circumstance? They're either going to have to bear it out and work themselves through the recession and do nothing, or the only other option is they may bring back bond buying, which I think is a remote possibility, but is a possibility that's still on the table.
Thanks for that, Pete. And thank you for watching this edition of For Pete's Sake. As always, comments and questions are welcome at newsfeedback@kitco.com. Have a good one.